In Chapter 13, we're going to discuss financial issues for nonprofit organizations. Let's talk about some key financial concepts. I realize for many of you this will be a review, but because this is a broad overview of nonprofit organization, it's important for us to take a look at some basic financial concepts. So let's talk about the difference between bookkeeping, accounting, and financial management. Bookkeeping is the methods and systems by which financial transactions are recorded, either by hand or on a computer. Know that definition. Accounting, the rules by which financial transactions are classified and reported. There's financial accounting and managerial accounting. Financial accounting is financial information published for use outside of the organization. Managerial accounting, on the other hand, is information that is used internally but is not required to be made available to others. So it's an approach to accounting. Managerial accounting is a planning tool and is different from financial accounting, which is used for publication outside of the organization. Financial management relies on accounting statements for data but focuses on their meaning. So financial management is an interpretation, and it relies on accounting statements for data but focuses on their meaning as opposed to just the numbers. So that's the financial management part of it. So differentiate between financial management and financial accounting. They're two different concepts, and don't get those confused. The key in bookkeeping is accuracy, in accounting, consistency and following the rules, and in financial management, making judgments and establishing policies to guide the organization's financial life. So that's an interpretation of the differences. So let's review that one more time. The key in bookkeeping is accuracy. So that's making sure the numbers are right. The key in accounting is consistency and following the rules. And in financial management, it's making the judgments and establishing policies to guide the nonprofit organization's financial life. So those are terms that you'll want to understand the differences between those concepts. In this slide, we discuss revenue as the principal challenge for the nonprofit organizations in terms of finances. The principal financial challenge for most nonprofit organizations is to generate sufficient and reliable revenue. Sufficient and reliable revenue are the challenges. Now this would be both for short-term operating costs that are needed to operate the nonprofit on a daily basis, as well as the long-term capital needs. So those would be the larger monies that are invested in the organization for a variety of capital needs. Diverse sources of revenue will minimize risk and maximize autonomy for an organization. So the more sources of revenue there are, the less risk there will be, and the maximizing of autonomy or the freedom for the organization or the independence of the organization. Now those sources of revenues we've discussed in previous chapters, and they include philanthropic giving, earned income, government sources of funds, as well as volunteer services. So those are all diverse sources of revenue. Now the sources realistically available to a given organization reflect the benefits it provides through its programs and services. So the greater the benefit of the programs and services, most likely there will be more sources realistically available to it. So it's a reflection of the benefits that the organization provides. Now we're going to compare the nonprofit organization's finances to your personal finances to help clarify the concepts. A nonprofit's operating funds, and those are the funds that are needed on a daily basis to operate the organization, can be compared to your own personal checking account. Payments received are intended to be spent within the same period to pay the current bills. Expenses may be limited by the budget, but it is possible to borrow funds to meet your current obligations. And there's a difference between restricted versus unrestricted funds. And so the difference in the restricted versus unrestricted funds would be that there's only a certain amount of funds available to meet those expenses during that period. So read the discussion in the chapter and understand that a nonprofit's operating funds are those funds that are required for the organization to operate on a daily basis, as opposed to the nonprofit's operating reserves. And the reserves would be like your personal savings account. So that's monies that the organization has put aside. And those are invested in a very secure short-term instruments type, like bank certificates of deposits or money market funds. Or maybe I should say they should be invested in very secure short-term instruments. The hope is that the reserves will not be needed to be touched, but it's important that they be preserved and kept liquid in case they are needed. So if the reserves are needed, that they are available and that they are kept liquid. Now, the existence of a hallmark of sound management would be that all of these operating reserves would be available to be tapped by the nonprofit organization should the need arise. So we continue to compare the nonprofit organization to your personal finances. The nonprofit board-designated endowments would be like your personal retirement funds. So those are endowments that the board then would decide how to invest. So this is where we're talking about perhaps an operating surplus that you look at as excess and how those are going to be invested. This is a long-term investment intended to provide additional income way in the future, or down the road a piece anyway. The board has the authority to withdraw the principal if needed. So this is where we're talking about the nonprofit organization's board-designated endowments, similar to retirement funds. It's money that's available to the organization, but it's not money that is used on a daily basis for the operating funds. And the board decides how to invest those. The nonprofit organization's permanent endowments. There's no comparison in personal finances to an endowment. So the explanation is that these are funds that are given by donors who have specified that the principal be retained to be invested in perpetuity, and that this is an investment income that may be used for current operating expenses, and that the board has limited or no flexibility in accessing the funds. So what this means is that the nonprofit's permanent endowments are depending on this particular nonprofit organization. There are funds that are given by the donors who specify how the principal is to be used. And that's where the investment income that comes off of these endowments can be used for operating expenses, and that would be the excess above and beyond. So the income that's derived from those principal or capital funds then would be potentially used for the day-to-day operating expenses. And then also that the board itself has limited or no flexibility in accessing those funds. So those permanent endowments are designed to generate this extra revenue that the nonprofit organizations can use for whatever their needs might be. But the principal itself are to remain invested for the long term. Physical assets of a nonprofit organization would include those tangible items such as buildings, vehicles, equipment, and other assets or items that are to help house the organization and to help it run. So those would be the assets that have a substantial investment, and they're quite different from monetary assets. They're generally illiquid. They're often difficult to measure their worth. They typically do not generate income. They can be sold or liquidated, but it would reflect a relatively dire and undesirable situation. So what that means is that you don't normally sell your physical assets to generate revenues, so that those are looked at as illiquid, difficult to measure, and do not generate income. So understand that that's what a physical asset definition is. As I mentioned earlier in the chapter, this is a general and broad-based overview just to give you some basic concepts. So we're going to talk now about the difference between cash-based and accrual-based accounting. The cash basis is where financial transactions are recorded only when the money changes hands and does not include expectations about future expenses such as accounts payable and income such as accounts receivable. So that's all done in cash. The accrual basis, which is what most nonprofit organizations should be using if they're not using, where the financial transactions are recorded when there is a binding commitment. It's mandated for external financial reporting for other organizations and does not track the cash flow per se. So the cash basis would be all cash. Accrual basis actually records the financial transactions when there is a binding commitment. The purpose of this slide is to let you know that there are rules for nonprofit accounting, and these were established by the Financial Accounting Standards Board, the FASB, and these are individual standards that have been created. Number 93 talks about accounting for depreciation. Number 95, the statement of cash flows. Number 116, accounting for contributions received and contributions made. Number 117, financial statements for nonprofit organizations. And number 124, accounting for certain investments held by nonprofit organizations. So you can go online and look up FASB and look up these particular accounting standards, and those are specifically designed for nonprofit organization rules for accounting. So let's talk about an overview of nonprofit organization financial statements. The first one we're going to talk about is the balance sheet. Now that's a statement of financial position or a snapshot of the organization's assets and liabilities at a single point in time. The income statement is a statement of activities, which shows the flow of revenue and expenses of the organization and the resulting changes in net assets over a period of time, typically a fiscal year. The statement of cash flows shows cash inflows and outflows over the year. Don't confuse that with cash accounting. This is a statement of cash flow, showing the cash that comes in and the cash that goes out over the year. The statement of functional expenses shows how expenses are allocated across various categories, such as programs, fundraising, and operating expenses. So those are the statements of functional expenses. Now there's other relevant concepts such as net assets, which would be the difference between the assets and the liabilities. It's a concept which is showing the difference between assets and liabilities, which would be called net assets. And then also depreciation. And depreciation is the decline in the value of the physical assets. The book has an example of a statement of financial position, so take a look at that and understand what that statement is. Because if you're going to be working with a nonprofit organization, you are going to need to have a basic understanding of financial management. Here's another statement, and this is the statement of activities where you show the revenues and then you also show the expenses and then the difference between the two. As mentioned earlier, this is an example of the statement of cash flow. This is the statement of functional expenses, which is essentially all of the different kinds of expenses over different categories. So this is what you'll want to take a look at and understand what that statement reflects. Your text includes a discussion about financial ratios. The key question is, how can we interpret financial data and use it to make decisions about the financial management of the organization? Well, you can use financial ratios to assess the financial health of the organization. The profitability ratio would be the change in net assets on the statement of activities. The liquidity ratio would be the organization's use of cash. Asset management is the organization's use and management of the fixed assets, and long-term solvency is the long-term financial outlook for the organization. So read the section on financial ratios and understand profitability, liquidity, asset management, and long-term solvency, what those terms mean. One of the unique attributes of a nonprofit organization is an endowment. Now, not all nonprofit organizations have endowments, but a lot of them do. And most endowments are held by the larger of the institutions, the nonprofit organizations, such as Harvard University has a huge endowment, Salvation Army, Metropolitan Museum of Art, Nature Conservancy. And these would be those large pots of funds that are held in perpetuity, of which then the income that is generated by the investment of those endowments goes toward operating the nonprofit organization. Now, some endowments are also held by smaller organizations, and examples in your book were City Year, Volunteers of America, and Boy Scouts of America. So compared to the others, they're smaller endowments, but they're still endowments, and they help operate the smaller organizations. Endowment funds oversight is very important for nonprofit organizations, and the endowment management is governed by each individual state. We're going to talk about the total return approach to endowments, and this is a strategy of maximizing the total interest, dividends, and appreciation in the value of stocks and other assets. So managing the risk by investing in a diverse